Hey everyone, welcome back. Today we have a special episode on how to use the Fibonacci, how to use projections to predict your targets, and basically what I personally pull in order to be able to project where price is going. So that's gonna be the secondary part of this video, showing you kind of the more advanced stuff. The beginning, we're gonna talk about the primary use of the Fibonacci in more beginner terms. And what is the Fibonacci? The fib is meant to measure a percentage of an impulse or a percentage of a leg or a percentage of a candle. And you guys have probably seen the supply demand side of things where you have premium pricing and Discord pricing. So let's start there, and then we're gonna get to the cooler, more advanced stuff. So on my screen right now, you see two Fibonacci's. First, let's focus on this guy on the right, and then we're gonna focus on this guy on the left after. That's a little bit of a more advanced fib, but the uses are very similar. So this is the 1, the 50, and the 0. This is the median. What can we do with this Fibonacci? We can essentially measure price. So if this leg went here and pulled back, in the case of those traders looking to only maybe buy in discount and sell in premium, that is one use of it. And the other aspect of it is obviously the backwards version of this, and that is where price goes down, pulls back to premium, and then you can look for a sell there if your bias is sells. So this works okay on Forex pairs. This works okay on stuff like Euro USD, GBP USD. As you get into certain assets such as gold or NASDAQ 100 or US 30, they don't tend to pull back as much. So this concept's utilized a lot less. So on Forex pairs, I would also always measure the pullback, and I would use the pullback to measure how far I think the next leg will go. On gold, rather than measuring the pullback, I found measuring the reactions is better. So what does this look like on an actual chart? So right now, so this price action here is very unhealthy and very unnatural right now. We're gonna probably rewind back a few weeks, and the reason being is right now we've had a government shutdown. Because of that, there's been no CPI, no NFP. And what these news do is they reset the market, they allow profit taking, and they ultimately allow the market to breathe and restructure. There is no proper structure here. This is just straight up. This is the last bit of proper structure that I see, and everything, despite it just moving up, this is actually not a healthy tradable market. So let's move back a bit. Maybe we're just gonna rewind maybe somewhere to here. So obviously gold is very bullish. So there's different uses of the fib. The first is you have to determine the kind of market conditions you're in and if the fib is usable at all. So we have trending market conditions and we have consolidating market conditions. What does this look like? So in consolidating market conditions, price would do something like this. And the way I use the fib in consolidating market conditions, I know that I only want to play the edges. So what I would do is I would essentially pull the high and the low of all the ranges, and I will eventually avoid any buys or sells in this middle area. Why? Because you have a higher chance of becoming liquidity in that area. So that I know that if price is going sideways, we want to look for buys at the extreme of the fib. I know that if price is going sideways, we want to sell at the extreme of the fib. This keeps us from becoming liquidity with the majority of retail traders that decide they're going to chase every single move. So that is the proper usage of the fib in a ranging market condition. So let's see if we can find a good example. So this is on the 1 hour, but hypothetically speaking, I could consider this. So this to me almost looks like it could be a trend. After price breaks down, comes out to the median, I could almost start pulling this fib and change my objective playing range to this. What does this do for me? This tells me that I want to avoid any moves in this middle part. So how do I play this? Just what we talked about. So in here, in here, in here, in here, these become playable moves. Now, if I want to get a little bit greedier because I'm not getting enough trades, I could do something like this, where I say I'm just going to avoid the middle part here, and I could still play these edges. What does that look like? That opens up an extra trade here, an extra trade here, an extra sell here, an extra sell here. So you can see how we can use the fib and adapt to the price action we're at. So that's kind of the ranging conditions. By the way, this is a 2-month period and we're on the 1 hour. You could go down to the 15-minute and apply the same concept to, 4 or 5 days PA, a week's PA instead of 2 months. I'm showing you the higher time frame because I mainly use the higher time frame myself and I mainly hold. So next we have the next part of this video. If I have this as a range, actually this would be our first range because this leg breaks this, so this would be a range to me. So let's just mark that out. So this would be a range to me. I have other videos on this channel about how I get ranges. We won't be going over it in this video as I want to keep this purely Fibonacci focused. Okay, now that we have our ranges, we can see here we realign with the daily time frame, and ultimately what we want to do is we want to determine what the market rhythm is. What is the rhythm? The rhythm's the heartbeat. And what does that look like? So this is how I use the fib to project and to also understand where a pullback's possible. If the market's doing something like this and it's heavily trending, as gold often does, I could look at this and be like, hey, price is heavily trending because we're above the 50. If this does this for 2 legs in a row or more, there's a higher probability that we're going to stay above the 50 than there is probabilities that we're coming below the 50. So this is telling me that the market rhythm right now, or the heartbeat as some would call it, is somewhere in this 236, 382 region. Don't get too hyper focused on being to the exact fib. It's either above the 50 or below the 50, and that's how I break it up. Generally, when gold trends, it's the 236, the 382. Very rarely is it going to touch the 50. If it's pulling back to the 618 and the 786, it's not really a heavy trend. It's almost a lower volume market, and usually it's around the summer or Christmas area. So what I will do with something like this is, if we look at the bottom area here, if this is my range from 0 to 1, I'm gonna look to see where this point reacted. And I can basically be like, hey, this area reacted at the 618. So now if we're applying the Fibonacci extensions to this method, what I'm gonna do is I'm gonna go to the 1618, and there's a good probability I'm gonna create a reaction there. So now what I have to do is look to my left. If we're not making an all-time high, if we're making an all-time high and you have no price action to the left, you are strictly gonna be playing fib levels. Whereas if I am having structure to the left, my job is to look at what's the closest point of liquidity or structure that can react here. So that's my first confluence. My second confluence is gonna be pulling this next range, and then I'm gonna go look, where is the first level fib level that intersects with this fib level, and I have the 2618 levels intersect. So that's where I'll look to the left. I'll be like, is there something right below or something right above that can create a reaction? And it may cause me to exit the trade early. So what I'll do now is, let's say this is my next leg and we get another fib level that intersects with these two. So this is a very strong reactive area to me. So now if price pulls back and I happen to get in here, I know that there's a very good chance that when I clear this high and I get to here, I should be looking at either taking heavy partials or closing or expecting a reaction. And this allows me to anticipate when the move could end based on the past data. And this past data is coming from the previous ranges or previous legs. And that's what I'm saying right now. We've had the government shutdown, we've had next to no news, and the market's just doing this. There's no current legs or structure or ranges to be able to create a hypothetical environment of where price could go or why. In order for the market to be healthy, it needs to be expansion, contraction, expansion, contraction. When it's just expansion and there's barely any contraction, it becomes a very risky market to trade, and the edge is no longer in our favor, but in the institution's favor. So I'm personally sitting this market out, and that's just years of my experience telling me to do so. Because just because it's climbing higher and going with the daily trend doesn't mean it's a higher probability move. So back to our ranges here. So you can see we're bullish here. We pulled back slowly, went bearish here very briefly. No, this is not even a range, sorry. So when we broke this low here, unconfirmed bearish here, and then here ultimately we become bullish again. There's a bunch of internal structure in here. I'm not going to mark it. I'm not going to mark for you guys. Again, there's multiple videos on this channel, how to do ranges, including in our course that is free on this YouTube. So my next area of interest is gonna become, so this would be likely the lowest point. This to me would be the first valid structural pullback after the break. First valid structural pullback, and hypothetically, so this is structures I see now, and hypothetically, obviously very bullish. So how does the fib apply to this? So let's take a look at this. If these are my ranges, by the way, this is again higher time frame. This can be applied on any time frame. We're using this on the 1 hour because the 1 hour is about the lowest higher time frame that I'll use for any kind of bias. Knowing your asset is key here. So I know gold likes the 618 expansion. That's just the way gold behaves. Indices and Forex pairs all have their own expansions. If you trade your pair long enough, you will understand where this pair will react. So what does this mean for me? I would automatically assume there's going to be a reaction at the 618. And then what I like to do is I like to see where the first nearest fib level to me is of the next range, which is the 027. And if you look, we have a magical reaction. What does this tell me? This is a good place to pay myself. I took this trade from here up and I exited here just like that. So what happens now? Now that the 618 reacted on this, I also expect the 618 of this range to react. And again, this will be different for any pair. So now this fib's very important to me. Is there another fib level that intersects? Cool. So the reason I like this tool is I like to have multiple fib levels as a confluence, and I will use the center of this tool of mine to basically tell me where's a good place to exit. So I bought this once again, and same thing, we exit here. So now, as we're going up, what do we notice? Well, price is barely pulling back. You can say price is hardly even reaching the 236. So I don't expect a lot of pullback. So what does the next range do? My expectation is that price is gonna stay above the 50. So let's just break this down. Price stays above the 50. I can look for a buy. Where's my next reactional area? Because I understand gold, it would still align with our current 618s. And this is where the fib becomes magical. As you get to know your pair, look at how our 3 levels of fibs intersect based on our ranges and our impulses, and look at the kind of reaction we get. So now, by the way, after about 2 or 3 reactions off one fib level, I'll stop using that fib level and I'll carry it on the fibs through higher levels. So what that means is now I'm gonna pull the next range. Once again, we're maintaining this market rhythm. We're still staying out of this 50 area and we're still reacting above the 50. So when the market's maintaining a rhythm, it's saying there's healthy price action, it's saying institutional money's present, and saying institutional money is driving it. So I will once again look for my 618 expansion. We have another fib level here. We have another fib fib level here. It's the next area to pay myself. Next, we have this range, and you will get better with this as you understand how the market moves. So when you have 3 or 4 fibs on an area and you're not sure which levels to go with, I find the area that's the most heavily concentrated with the most amount of fibs is the most likely to react. So what does that mean? We have a fib level here, we have a fib level here, we have a fib level here, we have a fib level here. Even though I prefer the 618 expansion, if I have multiple other fib level crossings below, I can do something like this and basically tell myself that's 1 fib, 2 fib, 3 fib, 4 fibs, and this block covers all 4. So this is a good area to pay myself. If this is not enough of a run because maybe I need more risk to reward or whatever, I'm gonna do something like this, move up to the next fib levels, and then my next reactive area happens to be here. And what do you know? It's the institutional 4,000 level. What do we know about 4,000? Very likely to react. So I think by now you guys understand of how it is I use the fib. So let's just see, do we get a reaction there? So 4,000 doesn't react right away. Where do we go? We go to the next fib levels, and you will get better at placing these and knowing which fib levels to follow as you understand your pair more and as you understand pullbacks, expansions, contractions, market rhythm more. It's actually a very simple concept, very useful tool in terms of understanding where the market could go. And once you understand the rhythm, you can basically follow it on up and understand how this will play out long term. So I hope you guys enjoyed this video. If you want to see more videos like this, comment down below and let me know, and give us a subscribe. I will see you guys in the next one.